Hello, my name is Chris Narayanan. I am an Extension Farm Management Specialist here in West Tennessee, and today I'd like to present our outlook for 2021 as well as the importance of having a marketing plan. So we'll start with the corn and soybean outlook. We'll talk about supply and demand, our 2021 price projections, and then a few weather comments. Then we'll move into the section on marketing plans, starting with the enterprise budgets. Then we'll talk about basis trends, and then move into both a pre-harvest and a post-harvest plan. And finally, we'll add some closing comments at the end for people to think about. Our disclaimer, since this is recorded in advance, our price information and other information is as of January 12th, 2021. So I'd encourage you to do your diligence and look for any updates or contact me or any of your extension specialists or county agents to bring you up to speed. So starting with our corn outlook, what I'd like to do first of all is to talk about the global corn production and ending stocks. You can see that we were pretty tight in the middle of the 2000s, and then certainly after the 2012 droughts, we stayed tight. But from that point forward, we started we ramped up production, and while consumption kind of steadily moved along. And so we were in some surplus years in the middle of the 2010s. But here recently, we've started to come back down again and starting to normalize. Part of that is trade developments. China is, for example, rebuilding their hog herd, needs more grain to feed those animals. We're also seeing the trade agreements coming into play, so we're seeing more and more purchases. But on a global perspective, we're still pretty comfortable, but we are slowly getting a little tighter. As far as the U.S. goes, you can see that our production has really kind of ebbed and flowed. 2012, again, of course, was a drought year when we saw a sharp decrease in supplies. That in turn raised prices higher, encouraged more acreage, and then we've kind of been piddling along ever since. You look at the consumption plus exports in the latter half of the decade. Then you've seen that we've kind of stayed at this elevated level. But again, as markets start to adjust, we're starting to see a decrease in production and maybe a little bit of an increase for last crop year, but from 26 on, we've been in a downtrend. Moving on to the share of total global corn exports. The U.S. At one point was the leader. Still is, but that margin has shrunk tremendously. So, we go back to the 06, 07, where about 58% of the global corn trade was coming from the U.S., less than about 18% for Argentina, and about 11 or 12% for Brazil. That's changed now to 35, 21, and 19. So the gap is closing, and we'll talk about that in a minute, of what some of the things that are driving that. So looking at the Brazilian corn production, given their position in the world in terms of weather and the climate that they've got, they're able to produce two crops back to back. And you have their first main crop, which is harvested between January and April. And then you have the second crop, also called the Safrinha crop, means little crop. That's harvested between June and September. And what they found is that they can actually plant soybeans and then follow it up with corn right afterwards. And so, and I was in Brazil about a decade ago, and it was really neat. You would see a combine going, and almost in a cat and mouse, the planter right behind it, and they were going up and down the fields together. And so what they've, where the Safrinha corn crop used to be the smaller one, is actually now in the heavy red line, as you can see, especially in the 2000s, has really ramped up, where they're producing more and more on the second crop because they're able to produce the beans from the first one. So what does this mean for our price projections? Well, we use the U.S. stocks to use ratio. That is how much of ending stocks that we've got at the end of a marketing year divided by the total usage, including exports. So that'd be all domestic consumption as well as the exports. And then we plot it against the marketing year average price. And so what I want to show you here is you can see, for example, in 2012, 2013, in the drought year, we were extremely tight, a little over 7% stocks use, and we were seeing about $7 on the board as an average price. compare that to 2016, 2017, when we had a huge amount of production, we were sitting at about 15.5% stocks to use, and prices are right around just above $4, just below $4. And so what we found is a pretty good relationship here, about 70%, that can be explained by that stocks to use. So based on the USDA's crop reports that came out on January 12th, they are projecting a U.S. stocks to use of 10.65%, which puts us almost in the middle of this range here. And that projects a marketing year average price of $4.75. Now, I know as of the time of this recording, we're much higher than that. But remember, this is an average for the entire marketing year. That gives us a range of $3.50 to $5.80 is what we're expecting. What we're finding is the weather in Brazil is starting to become a little bit more conducive. So of course, now we'll think about what happens in the U.S. growing season. But for now, given where stocks to use are, we're pretty comfortable in this $3.50 to $5.80 range for an average of $4.75. So moving on to the soybean outlook. Again, we'll start with the global soybean production, ending stocks consumption, and the U.S. marketing average price. And you can see how the price has fluctuated over time. Go all the way back to the 08-09 year when things were very tight on the global scale. That was because of droughts in Argentina and a little bit in Brazil as well. You have the 2012 that we talked about with corn, same deal. It started to tighten up, although we had enough stocks on the soybeans that even though we had droughts in both South and North America, it didn't really tighten it up as much as it did back in 08-09. And the prices but the prices were reflecting and moving in sympathy with corn. You see a couple of years here since then where we were running in surplus, producing more than we were consuming on a global basis. But then now things are starting to normalize. From about 2016, we had a little bit of bump at 18, but then dropped to 19, 20s up. So it's a little lumpy, but we're starting to normalize, and you can see as the ending stocks in the last 3 years projected, even though the production has been moving up and down, the ending stocks to consumption is coming back. A lot of that, again, is going back to livestock feed, rebuilding the herds, especially in places like China, where they were at one point not importing as much. So, when you look at the trade wars, you can look at their hog herds. I would submit that both of them had a dramatic effect on their import needs and wants. But now, as they're rebuilding the herd and phase one of the trade agreement has come into play, now we're starting to see more imports going back over there. So as far as the U.S. is going, again, we'll look at where our marketing year average prices are here along the top. The heavy black line is your production for each crop year. Domestic consumption is in red. Exports are in yellow. Domestic consumption stays pretty stable. There's a little bit of ebb and flow here. Obviously in 2012 when supplies were getting tight, we rationed a little bit. But on the exports is really where it gets lumpy. A lot of that, like I said, is when we have three major players of soybeans in the world, U.S., Brazil, and Argentina, it doesn't take a whole lot to tighten or expand the export program in the U.S. You really have to look at any restrictions as well as currency movements and who's the cheapest origin and who can get it to and who's also the cheapest transporter to get it to where it needs to go. And finally, looking at the share of total global soybean exports for Brazil and the U.S. and Chinese imports. Right here, this from 2016 to 2018, you can see a dramatic drop in soybean imports to China. I would submit that that's really a function of their hog herds. When they had that virus come through and it really killed 2/3 of their hog herd, you had a dramatic decrease in soybean needs for feed and the meal and that goes along with it. So they didn't need to improve. That also coincided with the trade wars, so that added some pressure as well. Now we're starting to see a little tick higher and back up to about 60%. So still above average if you go on above the long-term average. Brazil, you can see, their share of the soybean exports, like I said, they're one of the three big players. Back in 06, 07, they were about 32% of the world's trade in soybeans. Now they're up to 50%. And at some point last year, they were even higher, about 55, 56. For the U.S., it once enjoyed the top exporter of being the top exporter of soybeans. Now we're at about, back then it was about 41, 42%. Now we're down to 36. Brazil and Argentina have really entered that mix. And now, like I said, you really have to pay attention to the currency markets and the freight costs, because at some, all of things being equal, people will buy from the cheapest, and that's on a delivered basis. So you have to do the math or talk to somebody that is able to do that math for you to get an idea of how this stuff can change. And then finally, looking at the Brazilian soybean production, their consumption, exports, and ending stocks, just to kind of drive this point home, you can see that their domestic consumption on this red section of the graph, it's pretty stable. It ebbs and flows a little bit, but it doesn't. They only have so much that they need. Their main business now, especially in recent years, on this yellow section, is exports. Back then they would back in 06, 07, roughly half and half between domestic consumption and exports. And now you can see, up to this marketing year, where we're doing, if we're talking 5 million bushels, only about 1.5 or so is on the domestic, and the rest of 3.5 would be on their exports. So they have really entered that export thing. And that's, like I said, I keep beating that drum, but looking at those price movements and understanding it. And the other thing to realize too is, here's a great example where, and I remember this was going on a couple of years ago, about 5-6 years ago, where the Brazilian economy was really doing poorly. Their interest rates were rising, it depressed their currency. But because soybeans are priced in US dollars, they get paid in dollars and then convert that to Brazilian real. As their currency weakens, they get more real per dollar. So for them, they're making more money. And so everything else being equal, they had more of an incentive to keep planting soybeans. That added more onto the world market. That then, of course, cheapened the price, and especially in Brazil, because their currency was so cheap, people were going the other way, so they could actually spend less dollars to get the same amount of real of beans. And so it basically pushed the U.S. out, or at least reduced their export efficiency, and it was taken over by the Brazilians. So, people talk about outside markets, and I would argue that there's no such thing as an outside market. It truly is a global trade at this point. So on the price, our economist in Knoxville and I, ran it two different ways. First is with the U.S. stocks use, just like we did with corn. Where, if you look back to 0809, where we were, really, really tight, as well as in the 2012, 2013. Here we are now. 13, 14 was tight as well, and now here we are for the 2021 crop year. We're less than 5%. We're looking at stocks use of 3%. And so that projects a marketing year average price of $11.75 with a range of $10 to $13. Now, obviously, that's based on what we know as of January 12th. We'll have to see how the Brazilian weather, although that looks like it's no longer a concern as of the time of this recording. So make sure that you talk to us or your market professionals for any updates. But it looks like, we're going to start focusing on the U.S. growing season, but things are tight. And if they remain this tight, then this is where we expect prices to kind of fluctuate between that $10 to $13. But certainly it can go higher, certainly can go lower, depending on how weather and acreage and production trends unfold as the year progresses. The other way that we ran it was on the global days on hand. And that's simply how much consumption based on a 365-day year. And so we kind of say, how much do we have left over on a daily basis? And again, just like with the stocks to use, and this is on a global level, but just like the U.S. stocks to use, things are pretty tight. We don't have as many days on hand as we normally do. If you kind of look at the scales, whereas the kind of average kind of clusters right here between about 95 and 105, we'll call it. Right now we're sitting at 83 days on hand globally. That would project at 1175 with a range of 975 to 1375. So on a stocks to use for the U.S., 1175 is the marketing year average price. Same projection that we get on the global days of use. Our range for the stocks to use method is 10 to 13 or 975 to 1075. So a slightly wider range if we use this methodology. But bottom line is we are in a historically tighter situation. And it's, we've got some analog years as well. that we can kind of see where we have been in the past. And so that's where we see prices. Obviously, we'll have to see how the growing season progresses, what acreage numbers look like, what the growing temperatures and precipitation look like through the critical stages of production and growth. But for now, this is where we see prices. So moving on to weather outlook. This outlook was from NOAA. Was December 17th was when this was made. When I pulled it a couple days before the 12th of January to make this presentation, I did not see an update. So this is the one we're looking at. So again, make sure that you get an update. But this was meant for March, April, and May of this year. And you can see here in Tennessee, we're going to be hotter than normal during those months. And we're on the right-hand side, we're going to be wetter than normal. So think about that when it comes to planting. How that's going to affect your corn planting. Are we going to get more late beans coming in? Certainly that can shift the acreage. And the other thing too, this wet weather is all through the Midwest. So you look at Illinois, you look at Indiana, Ohio, Michigan, Wisconsin, all the way down to Kentucky and to the foothills of Missouri. So it's not just Tennessee. So here's a situation where we may not get as much planted in. Things might actually be tighter, and so prices can certainly go higher. Obviously, this is just a projection at this point. We don't know, but it's something you want to be mindful of and, keep watching. So with that, I'm going to change gears, and we're going to talk about marketing plans. Given all these unknowns that we've known, I think that I just discussed, I think it's really important now that we talk about what it takes to put together a marketing plan and also why it's important. So just going back to our dashboard here for a second, we've covered the outlook, and now we're moving into the marketing plans, and then we'll go into the closing comments. Now, before you construct any kind of a marketing plan, you must know your cost of production. To put a little plug in our managed specialists, and I'm one of them, our job is to help producers. We've got a software to put together budgets, balance sheets, cash flow projections, long-range plans, and even scenario analysis if you want to change the mix of your crop or maybe get into another enterprise or something like that. So reach out to your county agent. If you're in West Tennessee, you can reach out to me directly. Otherwise, your county agent can put you in touch with the managed specialist in your area. But we can, we're here to help you, and you need to understand your cost of production. That's going to be when you take your cost of production and you combine it with your expected production, so your APH or whatever you think is a reasonable estimate of what you can produce, that's going to provide your break-even price on a per acre basis. And then you can compare that to what where the market is trading, and then use that information to set yourself up a plan. Now, be sure to include any family living expenses or any kind of minimum income that you're relying on for expenses outside of your farm operation. So, if you've got a spouse that works out in town and they take care of all the household bills and stuff like that based on that salary, okay, that's fine. But if you're looking at, you need, whether it's you need a portion of the farm income to pay for something in your household budget, or maybe, something, kids' college tuition or whatever that is, make sure you include that in there, because and that's what I mean by total cost of production is not just for the farm, but anything else that you need the farm to help you pay for. So here's an example of one of our budgets. This is our 2020 corn budget. We're in the process of updating it, so we'll go to utcrops.com, and that should, in the next couple of weeks, have a 2021 budget. But you can see here, and I'm not going to go through every one of these numbers, just want to show you the format of how we use it. So on the top, we have revenue. So in this case, it's corn, any government payments, and any other revenue. Other revenue could be some custom work that you do, or anything like that. Your variable expenses, that's going to be your operating costs. So seed, chemicals, fertilizer, repair costs, machinery, crop insurance, that sort of stuff. And then your fixed expenses. So that's what you're going to have to pay for whether you produce a crop or not. So you've got your machinery costs, you got property taxes, any cash rent, management labor. That's your family living expenses. If you want to get paid from the farm. Other could be, again, if you want to, whatever you want to include in that you are relying on the farm to provide you as far as income has to be put into this budget. Now, very important that you realize that these budgets are illustrative purposes only. This is based on an average of Tennessee as a whole, but East Tennessee, Middle Tennessee, West Tennessee, we're talking about 3 different areas and very different dynamics and cost structures. So these blank lines here on the right-hand side is for you to put your own numbers in. Do not rely on these numbers because they may not be applicable to you. The only way that this is going to help you is if you use your own numbers. Now, if you need help, again, you can call me if you're in West Tennessee. You can talk to your county agent in other parts of the state and get in touch with your managed specialist. We're here to help you. But you can look at our budgets here, and I'm going to pause here for a second so people can write down this URL. But it's arec.tennessee.edu/extension/budgets. And so we have row crop budgets, we have livestock budgets, we have specialty crop budgets. We even have links to budgets from other states. But the idea is use this as a template, realizing that it's only for illustrative purposes, and you really need to do the work to put the numbers in yourselves. So now I'd like to talk about the seasonality of corn basis. Here, I'm using Memphis as the Port of Memphis as an example. So make sure that you get with us so we can help you tailor this to your particular operation in your particular part of the state. But you can see here, basis tends to stay pretty steady on average throughout the first part of the year. And then it dips down into the harvest and then slowly starts rising again. And that's a function of after harvest, obviously, and we'll talk about futures prices in a minute, but futures prices are going to be falling at that point because the market just got hit with a bunch of supply from the harvest. And so a lot of people don't want to sell at the lows. That's why basis starts bidding up, because now you have end users and merchandisers that are trying to coax those bushels out, and they do that by raising the basis. Now, this is a very important thing, and I highly recommend that you remember this. Like I'm going to beat my head in a hand down. Basis is the difference between cash price and futures price. So the cash price is your local price of where wherever you deliver. The futures price in Chicago. So cash minus futures is going to be your basis. Now, basis can be positive or it can be negative. So some people will say cash is, basis is cash, or they'll make basis negative or positive. But the idea is that the difference between your cash price, local cash price, if it's lower than your futures price, you'll have a negative basis. If it's higher, you'll have a positive basis. And you can see even on the seasonality here at the Port of Memphis, there are times of the year and certain years where you have a negative basis and sometimes you have a positive basis. It's not so much to worry about whether it's negative or positive as much as it is to understand the trends. When does it typically rise? When does it typically fall? And using that in your marketing plan will be extremely helpful. So remember, your basis is cash minus futures. Looking at the soybean seasonality, you see a similar dynamic. You kind of see on average, this dotted line here is your 5-year average. You have a slight raise in the middle of the growing season, but it's still pretty steady. But then it drops into harvest, and then it kind of skirts around for a little bit, and then slowly starts rising towards the end of the year. Again, beans are harvested a little bit later. The market gets hit with it, so futures prices come down. So the only way people can get the beans that they need is by raising the basis, especially in short years. So in 2019, for example, when we started seeing people not selling, they really raised that basis. 2020, on the other hand, we saw a kind of a downturn for a little bit longer than normal. But then once, we started seeing more exports and everything else, we started seeing that rise in basis. So basis is cash minus futures. So moving into this pre-harvest plans. So using these seasonal trends can help you price next year's crop. What you should do is set price targets and deadlines at regular interviews. Now, it might be every time the market, gains 20 cents, I'm going to sell a portion. Or maybe I'm going to do it every 6 weeks. Write this down. Keep a record of it. Whatever. The thing about marketing plans, it's not a one and done, nor is it a guarantee that you're going to make a profit. But over time, it will help you understand the market, understand why you did what you did, and also build out build out a plan for you to draw upon and also improve upon. Using your break even or whatever your risk tolerance is as your minimum price. So let's just say your break even was $3.50 a bushel for corn, but you said, you know what, I can lose 10 cents on that because I've got other income, so I'm okay. Fine. You use that as your minimum price, or you use your break even, or it might be, you know what, 350 is a break even, but I really don't want to price anything below than 360. That's fine too. Have a plan for it. Write it down. Write down the reasons why. And then using this historical data to determine a reasonable maximum price. So if you say over the last 5 or 10 years, it ranged from a low of this to a high of that during this time period, that might, you might use that high as your maximum price. Be reasonable, be realistic, don't shoot for the moon, but at the same time, you want to be able to connect the dots. So you have your minimum price here, you got your maximum price here, and you want to say over the next several weeks or months, over the next few price intervals, I'm going to be pricing a little bit at a time and selling forward. And that way, by the time, especially at a time like this, as of January 12th, when prices were really high, the market is giving you a time of year when prices typically are not this high. And I'll get back to that in a minute, but you want to be able to take advantage. Now, obviously, you don't want to extend yourself too far, before you even plant the crop. But I would say between 30 and 50%, if you can get that priced in before the harvest, I think you'd be doing pretty well. And then there's the pricing tools, which I'll get to on the next slide, to be familiar with. So you have forward contracts. You can short or sell futures. You can use hedge to arrive contracts. Those are all fixed price. You know what you're going to get. It's locked in, and then you can move on to the next one. Or there's minimum price things like buying put options. Gives you the right but not the obligation. Or maybe you'll do a forward contract and then buy options, call options on top of that. So minus the premium that you paid, you can still participate if the market goes a little bit higher. Again, this is not something that is a one and done or one size fits all. So come talk to us. And there's plenty of market professionals out there as well. But to help understand the basics of this, we certainly can help you. So now I kind of want to move into where we are on a crop year. This is on a calendar basis, and this is what I'm talking about with the seasonality of futures prices. So the 5-year range in this kind of grayish shaded area, and then in the orange line here, you can see where 2019 was, 2020 in this darker black line, and then just a little smidge over here is where we started on 2021. By the time you guys see this, it's going to probably be out to about here, or we'll be here on the calendar. We don't know where the prices are going to be, but so be mindful of that. But the idea is, you have pre-planting, you have planting and emergence, you got your tassel, dough, and then harvest, right? And so the market tends to rise. This blue line here in the middle of this shaded range is your 5-year average. And so you kind of stay steady normally. And then as you get into the growing season, it starts rising about May, June, giving you some opportunity, because at this point, the market's worried about weather. They're constantly looking at the weather reports. Is it too hot? Is it, too rainy? Is it, too this or too that? And the market will give you opportunities. Now, once the corn crop is kind of settled in the ground, the prices will start falling again. And then once you get into the gut slot harvest part, it's kind of when you typically bottom out, and you slowly start rising again in the fourth quarter of the year. And because of this drop, that's where you start seeing the basis that I talked about earlier starting to rise as well to coax some of this bushels. But in this January to June or July, middle of June timeframe, you should have some opportunities here to price it. Now, obviously, in 2020, we started seeing prices here at the end of the year rising, and it's continued into 2021. So we're here at a much higher than normal area. So this is the market telling you, hey, I've got some opportunity for you, a price that you don't normally see. So as part of your marketing plan, you might consider, hey, you know what? If I want to be pre-sold 30% at these levels between, April and June, maybe I'll do a portion of that now in January, February, or March, where the market is giving me a gift and allowing me to do that. Now, you don't want to overextend yourself and You want to be careful, but at the same time, you want to take advantage of these pricing opportunities. On soybeans, we see the same story. In that January to June timeframe into July is when it kind of tends to peak out a little bit. It gives you some opportunities. Again, the market's worried about the weather, and you should have every 6 or 7 weeks or every 10 or 20 or 30 cents. Have a plan, write it down, and say I'm going to price up to 30% or 50% of my crop at these intervals, whether it's a price, and it could be a price, it could be a calendar date, it could be both. Say, I want to get this price, or I'm going to price it by this date, whether it's that price or not. As long as you are above your break even or above whatever minimum price that you set. Remember to do that. Remember, this is all pre-harvest, so you want to make sure that you're not locking in a loss or too big of a loss that you don't want to lock in. So be mindful of that. But at the same time, use these opportunities and the seasonality for the market to allow you to price this. So then switching gears to post-harvest plan. Now, this is after you've already harvested and you've got some unpriced bushels. This is where you take advantage of those pricing opportunities and play defense. So, for example, you can see where prices on average in soybeans, November, December for soybeans, and to a little lesser extent in October, November for corn. You start seeing that rise. So this is where you play defense. Consider that basis. So go back to that basis seasonality charts that we're showing you and use it for your area. Remember, that's all this was as far as the Port of Memphis goes, but use it for your area. Understand the level of carry in the market. So is December trading at a lower level than March? And how much is that? And again, if these terms are not, if you don't know these terms, you're not comfortable with these terms, reach out to us. We can help you understand that. We're not trying to give you a full-blown marketing lesson in this quick presentation, but just trying to hit the high-level points, but we're here to help you. And also consider your storage costs and capacity. So if you've got on-farm storage, or if you've got an elevator where you can store, figure out the cost of doing so and factor that into your post-harvest plans, because the last thing you want to do is lose more money than you could have on storage, because whatever the storage cost was, and whatever that cost you is going to net you less money than if you had just sold at the market. So, and without on the spot market. So be mindful of that and have an exit plan. This is subjective. So you're going to have some kind of a minimum and maximum price tolerance. And you're going to say, by this time, so by March or May or whatever, I want to have all my old crop sold. I want to be done with it. Write that plan down and review that and understand why you did what you did. I would price this in increments into those seasonal summer highs that we talked about. So roughly the end of June, maybe a little bit of July, depending on what the market is doing. But you want to have that written down and say, okay, I'm going to have, let's just say you were 50% sold before harvest. So you have 50% and you sold another 20% at harvest. So now you got 30% that you've got to do between the end of the year and the middle of the next year. So have a plan, write it down. Again, I can't stress this enough, but if you need help doing that, give us a holler. We'll be happy to help you. And finally, in some closing comments, things to watch out for. Now, the wheat market, because it does have a complementary effect and substitution effect with corn, we expect that to soften up after dormancy. Globally and in the U.S., we have ample stocks. Now, of course, this assumes beneficial weather. At the time of this recording, things look pretty good. That could change, so make sure you verify this. But it's something to watch for, because if the wheat market starts to soften, you could see corn prices going along with that as well. The other thing to watch for is exports. The recent Chinese purchases have coincided with rebuilding of hog herds. Look at, and so, see if that pattern continues, if it increases. If it increases, certainly we can see even tighter supplies, everything else being equal. However, the flip side, look at ethanol. Last year in 2020, with the shutdown of the economy, people were not driving as much. So you needed less gasoline, which means you needed less ethanol to blend with it. What happens this year? Right now, the latest, the January numbers from the Energy Information Agency, EIA, the Department of Energy, has shown a drop in gasoline demand again. If that continues throughout the year, then any increase in exports that could tighten up the balance sheet, the U.S. stocks, could actually be offset by reduced demand in ethanol. So when you look at a supply and demand table, be mindful of them both. And with that, I will give you once again my contact information, especially for those any of y'all are who's watching is welcome to contact me, but especially for y'all West Tennessee, I'm the farm management specialist out here. My email is crn, just my initials, at utk.edu. It's probably the easiest email ever to remember. But reach out to us, reach out to your county agents. And I hope this presentation was useful for you. But if you have any questions, please don't hesitate to ask. And with that, thank you very much.